Hello everyone, welcome to Tesla Daily News. Today is June 8th, Monday, and the following is the latest Tesla news. According to the Motley Fool, Tesla is being framed by some analysts less as a pure-play artificial intelligence provider and more as an operator that embeds AI deeply into tangible products, electric vehicles, robotaxis, and the Optimus humanoid robot. This perspective matters greatly for long-term investors who are increasingly worried about a potential AI bubble. History shows that even when a bubble bursts, the timing is notoriously hard to call, and companies exposed to the bubble in different ways do not suffer equally. The Motley Fool article points out that Tesla's huge capital investment plans, roughly $25 billion in 2026, are focused on expanding its capacity in EVs, energy products, robotaxis, and Optimus, as well as on shoring up its chip and component supply chain. Importantly, Tesla and SpaceX are backing a chip manufacturing initiative called TerraFab, but the intent is to secure internal supply for Tesla, SpaceX, and XI rather than to become a merchant chip seller. In other words, Tesla is not building massive data centers to rent out AI compute, it is building AI capability into its own end products. By contrast, companies such as Oracle are aggressively investing in AI cloud infrastructure to sell compute to third parties like OpenAI. Oracle has even touted a $300 billion cloud computing agreement with OpenAI, which comes with significant capital expenditures and debt. If AI spending normalizes after a bubble, these hyperscalers could be left with heavy depreciation, large debt loads, and slower revenue growth as AI workloads reset to more realistic utilization and pricing. For Tesla shareholders, this distinction has two important implications. First, in an AI downturn, nearly every tech-related company would feel pain, and Tesla would be no exception. But Tesla's ultimate demand is tied to structural needs, transportation, energy storage, and potentially labor substitution through robots, all of which remain essential regardless of AI hype cycles. Second, if an AI bubble bursts, hardware, compute, and specialized chips could become cheaper as hyperscalers pull back capex, directly lowering Tesla's cost base for AI-intensive products like Optimus and full self-driving hardware. The article also flags risks. Tesla must still execute on ambitious plans in robotaxis and Optimus, where both technical and regulatory uncertainty is high. And any future merger with SpaceX, which is more exposed to orbital AI and XI revenues, could drag Tesla shareholders closer to the center of an AI bubble's fallout. Overall, though, the thesis for long-term investors is that Tesla may emerge from any AI correction with stronger competitive positioning and lower input costs, while still retaining upside from productivity gains as AI is embedded into its products. According to Finance.net, equity analysts in Europe remain cautious despite Tesla's recent share price strength. During May 2026, the Tesla stock was covered by a pair of analysts at Barclays Capital, both of whom reiterated a neutral stance, essentially a hold recommendation. Their average target price is reported at $360 per share, which represents a notable discount compared with the then-current Nasdaq trading level of about $435.79. This implies that, in Barclays' view, Tesla shares were trading significantly above what they consider fair value in the medium term. Over a 6-month horizon, the rating trend also shows a hold stance rather than a clear buy or sell conviction. For investors, this signals that at least part of the traditional sell-side community is still modeling conservative assumptions on Tesla's growth, margins, and monetization of software and autonomy. However, the article provides no evidence that these analysts have fully baked in the potential upside from large-scale robotaxis or humanoid robots. Instead, the targets likely reflect more conventional assumptions around EV demand, pricing, and competitive pressure from Chinese manufacturers and legacy automakers. Long-term Tesla bulls may see this as another example of Wall Street underestimating optionality, while more cautious investors might take it as a reminder that valuation risk is real if Tesla stumbles in execution. According to Ha News and Profit RO in Romania, Tesla's recent pricing strategy in Europe appears to be paying off with a strong rebound in sales. Over the last several months, demand for Tesla's main volume models in Europe, particularly Model Y from the Berlin factory and Model 3 from Shanghai, has surged. On key markets such as Germany, France, Spain, and the United Kingdom, Tesla has recorded growth rates that reach into triple digits, demonstrating that price cuts and promotions have successfully reignited interest among European buyers. The analysis notes that European customers have flocked to Tesla's website and the limited network of showrooms, taking advantage of more competitive pricing in the face of broader EV affordability concerns. On the supply side, the Chinese Industry Association reported very high output of Model 3 vehicles from Tesla's Shanghai plant, reflecting both robust domestic demand and strong export volumes into Europe. For investors, this is important on several fronts. First, it shows that Tesla can still stimulate volume significantly through pricing, reinforcing the thesis that it can act more like a scale carmaker when needed, trading margin for share in a targeted way. Second, the success of the three-point strategy hinted at in local coverage suggests Tesla is adapting regionally, leveraging European production in Germany, flexible supply from China, and aggressive pricing tailored to each market's incentives and competitive conditions. Third, the rebound undercuts the narrative that Tesla's European growth story is over. Instead, it points to a dynamic pricing-led expansion that may set the stage for future software and autonomy upsell once full self-driving features are more widely approved in the region. For Tesla enthusiasts, the European momentum also reinforces the strategic value of Giga Berlin as a hub for both volume models and potentially future variants. As legacy automakers like BMW and Mercedes race to catch up in software and EV platforms, Tesla's ability to flex pricing while maintaining brand appeal could be a crucial edge. According to Nezavision Novine and The Information, Tesla's long-awaited next-generation Roadster has been delayed yet again, frustrating fans who have been hearing about the car since 2017. The latest reporting suggests that a public demonstration, which CEO Elon Musk had most recently promised for early spring 2026, is now unlikely to occur before August at the earliest. Originally unveiled nearly a decade earlier, the second-generation Roadster was once scheduled to enter production in 2020. Timelines have slipped repeatedly as Tesla prioritized mass-market models and high-impact projects such as Model Y, Cybertruck, and advancing autonomy. Last year, Musk publicly targeted an April 1, 2026 event, a date that passed with no launch. He later floated May or early June, which also did not happen. What makes this latest update particularly notable is the emerging technical collaboration with SpaceX to equip the Roadster with a cold gas thruster system. According to sources cited by The Information and relayed by Nezavision Novine, engineers at Tesla and SpaceX are testing a system codenamed A71 that integrates advanced thrusters to dramatically improve acceleration and handling, potentially even enabling momentary liftoff from the ground under extreme conditions. Internally, there have been demonstrations of early versions of this technology to select Tesla employees and SpaceX engineers. Tesla is reportedly considering both a standard production Roadster and a special SpaceX edition with the full thruster package. If realized, such a car would push the boundaries of what a production EV can do and would likely reinforce Tesla's image as a performance and technology leader. For investors, however, the Roadster remains a symbol of both Tesla's ambition and its execution complexity. Nearly 10 years after the original reveal, there is still no firm production date, and the Roadster's financial contribution to Tesla's overall business is expected to be relatively small compared to volume models and software. The key question is whether the Roadster serves primarily as a halo project that showcases Tesla and SpaceX's engineering integration, or whether it meaningfully advances technologies such as high-performance propulsion, lightweight systems, and thermal management that can later cascade into mainstream vehicles. According to Reuters, as reported by Infobay in Argentina and Hoot in Austria, Tesla faces intensifying scrutiny over the safety and reliability of its full self-driving system and broader robotaxi ambitions. A group of 7 former Tesla data annotation employees, whose job was to label video clips and events used to train the FSD neural networks, told Reuters they personally would not trust the system to drive them. One veteran autonomy engineer reportedly characterized Tesla's safety claims as pure bluff, saying that inside the company they had seen too many failure cases to feel comfortable. These former workers described watching countless clips from the 8 exterior cameras on Tesla vehicles using FSD, highlighting frequent issues with what most drivers would consider basic tasks. They cited examples of the system failing to give enough space to motorcyclists, struggling to properly react to emergency vehicles, and mishandling off-ramp scenarios on highways. In at least one case, a Tesla reportedly followed an off-ramp and went straight into a concrete barrier, though the internal videos did not always reveal whether there were injuries. Reuters also reports that Tesla maintained strict internal controls over who could see the most disturbing clips. One specialized group, informally known as the Trauma Team, was said to focus on near misses and potentially severe incidents involving pedestrians. 3 former employees said there was a dedicated workflow for events where pedestrians were nearly hit. The Trauma Team, based in Palo Alto, operated under higher access restrictions. Nevertheless, some of these videos occasionally circulated to other teams, revealing cases where drivers had to take over at the last moment when FSD appeared not to recognize pedestrians at crosswalks. 2 former employees recall seeing clips in which Tesla vehicles under FSD control nearly hit children. Other accounts involve vehicles entering active construction zones, coming dangerously close to road workers after failing to respond appropriately to cones, signage, and lane shifts. According to Hoot's summary, these episodes contributed to a broader internal culture of caution among some employees, many of whom said they would not step into a fully autonomous Tesla robotaxi even if offered compensation. The reports also questioned Tesla's headline safety statistics. Reuters alleges that Tesla compares its FSD crash rate with national crash statistics that include a wide range of minor incidents, rather than like-for-like comparisons of severe accidents. Critics argue that this can make FSD look up to 10 times safer than human drivers in ways that may not hold up under rigorous scrutiny. Regulators are paying attention. The United States National Highway Traffic Safety Administration has several active investigations involving Tesla's autopilot and FSD features. One probe involves dozens of incidents where vehicles reportedly failed to stop at red lights or drifted into oncoming lanes while using FSD. Another series of cases focuses on collisions involving emergency vehicles, while a separate investigation looks at a fatal accident where limited visibility due to fog or sun glare may have contributed to an FSD failure. For investors and enthusiasts, this cluster of stories is a double-edged sword. On one hand, it underscores that Tesla is pushing aggressively towards autonomy at scale, training AI systems on massive real-world datasets that include rare edge cases. On the other hand, it highlights the human cost and reputational risk if the technology is deployed widely before it consistently outperforms human drivers in the most challenging scenarios. The negative tone from former insiders could feed regulatory pressure, slow robotaxi rollouts, and potentially increase litigation exposure. The same Reuters-based reporting cited by Hoot further notes that Tesla's robotaxi fleet remains far smaller and more limited than some of Elon Musk's public timelines might suggest. In Austin, Texas, where Tesla is closest to operating commercial autonomous services, only a few dozen vehicles, around 45, were reported to be active in March 2026, and even those are constrained to limited geo-fenced areas and under strict operating conditions. In California's Bay Area, Tesla has around 355 vehicles associated with a robotaxi-style service, but these are still driven by human drivers, essentially functioning as a ride-hailing operation rather than a true driverless fleet. Tesla lacks the full regulatory approval required for completely autonomous commercial rides in that region. This disconnect between branding and operational reality has led experts to describe some of Tesla's marketing as misleading. Scaling autonomous driving services beyond small pilot zones is enormously complex. It requires not just technical progress, but also robust safety validation, local partnerships, and careful coordination with municipal and national regulators. Tesla's approach, which emphasizes rapid deployment of beta software to customer-owned vehicles, is fundamentally different from the more conservative, geo-fenced strategies pursued by some competitors. For shareholders, the slow real-world rollout raises questions about Tesla's ambitious monetization assumptions for robotaxis. The idea that FSD software could justify tens of thousands of dollars in lifetime revenue per vehicle or create a global fleet of revenue-generating robotaxis underpins many bullish valuation models. If regulatory and technical challenges push broad deployment back by years, the net present value of that opportunity declines. At the same time, Tesla continues to gather data, refine models, and build infrastructure, which could position it well if and when regulatory breakthroughs occur. According to Jalopnik, Tesla's role in reshaping the auto retail model through direct-to-consumer sales continues to have deep implications for the industry and Tesla customers. The article revisits the tension between traditional franchise dealership laws in the United States and the DTC approach favored by Tesla and other newer EV makers such as Rivian and Lucid. Historically, state-level franchise laws were designed to protect independent dealers from aggressive behavior by automakers. These laws have long limited the ability of established brands to sell directly to consumers. Tesla, by contrast, never signed franchise agreements, arguing that these dealer protection laws should not apply to an automaker that has no existing franchise network. Over the last decade, Tesla has battled dealership lobbies and local legislatures, often on a state-by-state basis, to secure exemptions that allow it to operate company-owned stores and online sales channels. Tesla buyers today often experience the transaction much like ordering from a technology company. Pricing is transparent on the website, negotiations are minimal to non-existent, and the car can be delivered with relatively little interaction with a traditional salesperson. This stands in stark contrast to the experience at many franchise dealerships, where the semiconductor shortage and high demand in recent years led some dealers to add significant markups above sticker price, eroding consumer trust. The Jalopnik report notes that during the height of pandemic supply chain disruptions, a large majority of surveyed Americans believed dealerships were not honest about prices. That environment made Tesla's DTC model even more attractive, as customers saw it as less prone to surprise fees or last-minute price changes. While Tesla is not immune to pricing volatility, as its frequent global price adjustments show, those changes are typically set centrally and communicated clearly via its own channels. For investors, Tesla's DTC model has several implications. It allows Tesla to capture more of the value chain by removing the dealer margin and collecting data directly from customers. It also facilitates over-the-air updates, software upsells, and subscription models such as paid connectivity or FSD more seamlessly, since Tesla maintains an ongoing direct relationship with the owner. On the flip side, constant legal battles and legislative pushback in some states create friction and can limit market penetration until exemptions are secured. Other EV startups have followed Tesla's path, seeking direct sales structures and fighting similar legal battles, but legacy automakers with existing dealer networks face far bigger constraints. When Ford experimented with more direct-style EV sales, dealers pushed back hard, underscoring how entrenched the franchise system remains. In this context, Tesla's early and consistent commitment to DTC looks increasingly like a durable strategic advantage, particularly for software and service monetization over the vehicle's lifetime. Thank you for listening to Tesla Daily News. If you enjoyed this episode, please subscribe and stay tuned for more updates on Tesla and the future of electric mobility.